There are two people sitting in the same bank branch on a Tuesday afternoon in Columbus, Ohio. The first person is there to ask about a personal loan. She makes $68,000 a year. The bank says yes. The rate is 22.9%. The second person walks in 20 minutes later. He has a brokerage account with $400,000 in it. Rate is going to be somewhere around 6%, maybe less. Same bank, same Tuesday, same loan officer. That's not a bug, that's the product. My name is Horizon, and today we're going to talk about the most profitable customer in the history of American capitalism, the middle class, the person making between $50,000 and $150,000 a year, the person who has just enough to be worth extracting from and not quite enough to know the extraction is happening. The middle class is the product. The middle class is the inventory. The middle class is the cow. There's a concept in business called the ideal customer profile. Poor are a bad customer for the financial industry. Rich are also a bad customer for most of the financial industry. They have options, they have advisors, they have negotiating leverage. The middle class, too rich to be ignored, not rich enough to have leverage. Checking account is not on your team. Your bank takes your money and lends it out at 7, 8, 9%. For the privilege of holding your money, your bank pays you 0.01% dollar per year on $10,000, $1. Let's talk about overdraft fees. You have $4 in your checking account. You spend $6. Your bank charges you $35. That is an annualized interest rate of approximately 40,000%. Percent of bank account holders pay 80% of all overdraft fees. 9%. The same group of people, over and over, paying the same fee, for the same structural reason. 2010, the Federal Reserve required banks to get customers to opt in before charging overdraft fees. Banks responded by sending letters framing a $35 fee as a service. They were getting the privilege of paying $35 to borrow $2. The rewards card is a machine that transfers money from people who carry balances to people who pay in full every month. MIT researchers ran studies. People spend more when they pay with a credit card than when they pay with cash. 60% of American credit card holders carry a balance. Most of them are middle class. The system is optimized to reward people who don't need rewards and extract from people who do. Your mortgage rate has two components, the treasury yield and the spread. For most of modern financial history, that spread was roughly stable, around 1 3/4 percentage points. Then something changed. The spread blew out, pushed toward 3, the widest since the 1980s. The ground didn't move. The toll went up. Somebody decided turning Joseph's loan into a bond was suddenly a riskier thing to do and passed the cost straight to him. Joseph is 31. He makes $85,000 a year. He's trying to buy a $400,000 house. The extra 3/4 of a point costs him roughly $2,000 a year in additional interest. Joseph didn't cause this. He didn't vote for it. He doesn't fully understand it. He's just paying for it. Middle-class borrowers have no pricing power. Research found that mortgage borrowers who shop 5 lenders save an average of 1 full percentage point compared to those who go with the first lender. Here's a number that should permanently change how you look at your 401k statement. 1%, percentage point in annual fees over a 30-year career, costs the average middle-class worker between $100,000 and $200,000. Then half of Americans didn't know they were paying fees in their 401k at all. Not that they didn't know the amount. They didn't know fees existed. The fees are deducted automatically, invisibly, from the value of your fund before the daily price is ever calculated. People with identical driving records. One pays $400 a year for car insurance. The other pays $900. The difference is their credit score. The product is priced inversely to ability to pay. The average American household pays for somewhere between 12 and 17 subscription services. The average household dramatically underestimates this number. When surveyed, most people guess 8. The actual answer is 12 to 17. $150 a month at 7% for 30 years is $543,000. The renewal is automatic. The cancellation requires action, which requires awareness, which requires remembering the subscription exists. The non-user is the most profitable subscriber. They generate pure revenue with zero cost. The tier system. The free tier is annoying enough to motivate upgrading. The basic tier has exactly one feature removed to make it frustrating. Your grocery loyalty card gives you a discount. The store tracks every purchase you've ever made and sells that data. The global data economy is worth trillions. The raw material is consumer behavior data. The most valuable is from the middle class. Dynamic pricing. The same television on the same website costs different amounts depending on what the algorithm knows about you. Maria. She makes $75,000 a year. She's doing everything right. Mortgage has a spread of 2.5 percentage points. That extra 3/4 of a point costs her roughly $2,000 a year. 401k plan has an expense ratio of 0.9%. That costs her $810 this year. Car insurance costs an extra $300 a year because her credit score dipped 2 years ago. The driving record is identical. Carries a credit card balance of $3,000 at 23.79%. That's $713 a year in interest. Subscriptions cost $40 a month more than she thinks they do. It up. $4,468 a year. Extracted from Maria not because she did anything wrong. If Maria redirected $4,400 a year into an investment account for 27 years, that grows to $368,000. That's almost a full additional retirement account, sitting in the machine's pocket instead of hers. The credit card reward system transfers money from balance carriers to point redeemers, yes, but it also built the infrastructure that lets you buy anything from anywhere. You are not the customer the way you think you are. You are the product, and that's not a permanent condition, it's just the default setting. 5 moves, in order. The first move is know what you're actually paying. People cannot tell you their 401k expense ratio, their credit card interest rate, their mortgage spread, or the total monthly cost of their subscriptions. The second move is automate the saving before the machine gets to it. Getting 5 quotes instead of 2 on a mortgage is worth more, in terms of lifetime dollars, than almost any other financial decision you'll make. Find out what you're paying in fees. Look for the expense ratio on every fund you hold. A timer for 20 minutes. Pull up your bank statement and your credit card statement. Highlight every recurring charge. The compound value of these 5 moves done once and maintained is, for the average middle-class American, in the hundreds of thousands of dollars. The middle class has been told that financial difficulty is a personal failure, that people who struggle with money lack discipline. Sitting underneath the personal decisions is a machine. A large, sophisticated, well-capitalized, decades-old machine. The move is to make yourself slightly more inconvenient to extract from. The machine will still run. It will still extract from someone, but it doesn't have to be you at this rate on this schedule indefinitely. Look at what you're actually paying. All of it. That number is the gap between the financial life you have and the one that's possible on exactly the same income.